All right, welcome to Chapter 11. In Chapter 11, we're going to be discussing what's called a bank reconciliation. A bank reconciliation is done at the end of the month to bring the balance that you have in your checkbook in line with the balance that you have on your bank account. There are certain things that happen during the month that make these balances go off. And it's up to you as a bookkeeper to figure out what they are and to adjust those balances accordingly so they equal and you can go on to the next month recording your transactions. So here we go. Here's a scenario of what might take place during the month and how we would remedy it by making the balances equal each other. So Kids and Pups, which is the name of your company, has a cash account that shows a balance of $5,882. This is on June 30th, at the end of the month. The balance on the bank statement for the same date, June 30th, shows $5,260. Okay? There are also some other things that took place during the month that would set the balances off. For example, we had some outstanding checks. An outstanding check is when you write a check from your business to somebody, you give it to them, and at the same time, you reduce the balance in your checkbook, but they haven't gone to the bank yet with the check that you gave them. Maybe they put it in their pocket, they just haven't got around to deposit it yet. So you've reduced the amount on your checkbook, but the money is still in your account. You don't have that money because you wrote the check, but it's still in there until the person you gave the check to actually goes and deposits it. The other one we're going to look at is called a deposit in transit. Now that's when a customer gives you a check. So they pay you for a good or service, and you record it in your checkbook as money that you received. You go and make a deposit, and you bring it to the bank. Well, the money doesn't come into your account at that exact moment. They have to check to make sure that that customer has enough money in their account before they can release the funds into your own account. Right? So that's what's called a deposit in transit. You increase the amount in your checkbook, but you don't have the money yet in your account, so there's a difference between your two balances because of that occurrence. Other things we're going to look at is called a non-sufficient funds check, or an NSF check. Simply what that means is that a customer gave you a check, and when you went to go and deposit it into the bank, they didn't have enough money in their bank to cover the amount that they wrote out to you. So when you initially got that check and made the deposit, you increased your checking account for the amount that they gave you. No problem. You went to the bank and put it in, but now you're not actually going to get any of that money. So you now have to go back and adjust, let your checkbook know that that money isn't actually coming in because there wasn't enough money on the other side to cover the full amount of the check. Okay? Then we have a note that was collected. A note that was collected, this could be the form of interest. It's just something that comes when you get your bank statement at the end of the month, and it says, listen, you earned some interest, or there was some money that you collected in your bank account. Now you didn't record that in your checkbook yet, so the money that you have on your bank statement is actually higher than what you would have in your checkbook until you go back and you update the checkbook and add back that note that you collected. And then the last thing is a service charge. So banks charge a certain fee for them to handle the money that's in your account, to either do administrative things, to monitor your accounts. So at the end of the month when you get your bank statement, there's going to be a service fee there. And that service fee is something that they automatically take off of your bank balance. Now you don't know that, or you didn't record that in your checkbook, so now you have to go back and reduce the checkbook balance to show them the amount that they took out for the service fee. So these are the different types of things that could happen during the month that would lead those balances to be different with each other. Now we're going to go through the process of reconciling them using an accounting form to bring them back to balance. So the first thing you want to do anytime you fill out an accounting form, it's just like all the other accounting forms, right? You want to put a heading on top of it. So it's who, what, and when. The name of the company, Kids and Pups is the name of the company. The what, this is called the bank reconciliation. That's the form we're filling out. And we have on June 30th, which was the date that we received our bank statement, and now we're comparing our checking account. So where you want to start is you want to start with the balance in your bank statement. So the balance for the bank statement, and if you look in the directions, it says that the balance on the bank statement was $5,260. So you go ahead and put that over into the right column, and because we're only using these numbers once, you can now go up and you can cross that one out. So cross out 5,260. Now we want to go into the things that would add to the bank balance. So the bank balance would be the things that we did in our checkbook, recorded in our checkbook, but we haven't updated the balance in our bank statement yet. So the first thing that we're going to look at are our deposits. Those are the deposits that were in transit that we just talked about. So we would put the word additions right in deposits in transit, and then we looked through the instructions. It told us that we had a deposit in transit of $377. So we need to go ahead now and we need to add that $377 to the original balance of $5,260. We add that, and now the new balance, or what we're telling the bank statement it should have with the additions, is $5,637. All right? So that takes care of the additions part. Now we have to look at the things we did in the checkbook that would subtract from our banking balance. Okay? So what we would have in our deductions would be all of our outstanding checks. These are checks that we wrote, we gave to people, and they haven't deposited them yet. So the money is still in the bank account, and that's why we need to go ahead and deduct them from what they're saying the balance is, because we know that eventually those checks are going to come out. And if we look over here, we'll see we have our 3 checks. You would list the 3 checks. You would list them over in the listing column one at a time. Finally total them, and you come up with $300 as being your total deductions. Okay? Now what you want to do, so we got to make sure as we're going through the process that we're crossing them all off. So we cross off our deposits, we cross off our checks. And now that we have the amount that we deducted, we want to find the difference between that and what the additions are. So we would subtract the 300 from the 5,637. And what we get is 5,337. And that's what we're saying our bank balance should be. Once we added back the deposit and subtracted all the outstanding checks, this is what we're saying it should be, and we put 2 lines underneath to show that that is our final answer. So we just updated the bank with everything that happened on the checkbook. Now it's time for us to go and update the checkbook balance with everything that took place on the bank that we didn't know about. So you start the same way. You write the word balance per the checkbook, okay? You write balance per checkbook, and we look back up in the instructions, and we see that there was a balance on June 30th in our checkbook of $5,882. You start the process by putting the balance there, and the same thing, you always go in the same order. So if you look here, there's an acronym that we formed when we were doing the bank reconciliation. We use the word BAD to indicate the balance. Next we do our additions, and then after that we do our deductions. So we're doing the same form when we get down to the checkbook. We put the checkbook balance, but now we have to look at the additions. So what things took place during the month that would add to our bank balance, but the checkbook doesn't have it recorded yet? The first one we're going to look at is the note. So the collection of the note. We earned $160 on our bank balance. Now that's great, and it came when we got our statement at the end of the month, but we didn't record it yet in our checkbook, and that's what we have to go back and do now. So we're going to add 160 to the original balance, and that's going to give us a subtotal or a sub-balance of $6,032. So that's fine. So we have our balance, we have our addition, but now we have to go and look at the things that decreased our bank balance. The things that decreased our bank balance, but we didn't necessarily write in our checkbook yet. So the first one that we're going to look at for our deductions is the NSF check. All right, so when a customer gave us the money, they wrote us a check and they gave it to us. We wrote in our checkbook that we were going to receive $660. But guess what? We went to go deposit that in the bank, and when we did, a couple days went by and they didn't have enough money for us to get the check. So the bank returned the check, or they had non-sufficient funds, so we couldn't actually get that money. So what we have to do now is our checkbook is showing that we're receiving $660, but we're never going to get that money. So what we have to do is we have to reduce it for the $660. So that's a deduction that we're going to have. The next one that we have is a service charge. So the service charge was at the end of the month the amount that the bank charged us. And you see it comes out, $35 would come out of your account, and that would reduce the balance you have in your bank account. Well, we didn't write anywhere in the checkbook that $35 was coming out. So now we have to reduce it from the checkbook balance. So $35 is another deduction that we're going to take off. So we put $35. Now what we do is we take our 2 deductions and subtract them from the subtotal. And when we do that, it gives us $5,337 as our adjusted checkbook balance. We put 2 lines underneath it to make sure that that's our final answer. And the way that you check, nice thing about accounting is there's usually always a way that you can check your work. So if the adjustment on the bank statement is equal to the adjustment or the adjusted balance on the checkbook, if these 2 equal each other, you're good. You now have reconciled and you brought both your balances. You told the checkbook everything that took place in the bank statement that it didn't know about, and you told the bank statement or the bank balance everything that took place in the checkbook. You basically updated the 2 of them with all the information that they didn't know about prior. This is how we reconcile a bank account. We're going to be moving on to doing payroll and other things in the next chapter. This will conclude Chapter 11's version of how to reconcile your bank account. Thank you.